Shalom mes enfants, welcome to World Economic News, because it is economic, because we're going to start with this world issue of AAA fixed income securities. It's a very interesting chart. Let's have a look at it from about 2003 to 2007 and have a look at those uppity up bars and see what they're all about. So these are AAA rated securities out there in the world, between $4 and $5 trillion worth, and they're made up of sovereign debt at the bottom, that lilac colour. The burgundy colour is asset-backed securities, mortgage-backed securities, that sort of thing, packaged by investment banks and things like that. Then you've got corporate bonds and other. Okay. So the regulators were insisting on banks holding AAA rated securities if they wanted to hold absolutely minimum, sometimes zero, money to back those up. If they had riskier things, they had to have bigger backup. So there was a great demand for these AAA securities, so they could just buy them and not hold money back, where they could just go and buy more and more and more of these. So there wasn't enough sovereign debt out there which was rated AAA, because most all sovereign debt was rated AAA. So the investment banks made up these fancy things, and things that went and shouldn't have been AAA, they carved them up so they could be rated by the rating agencies as AAA, then sold as AAA, held as AAA. The capital ratios minimum, and money was freed up in the banks to go and do other things. You can see when things hit in 2008, those carved up securities from the investment banks dried up. They've come back a bit now in 2009, because this is the Bank for International Settlements, so they've waited for all the numbers to be really in properly. And what we've got now is an increase in corporate bonds, because they can get corporate bonds away really cheap at the moment. They can get lots of money in and not pay interest on it. A lot less of the asset-backed securities, but look at the mega hike in sovereign debt that's come out. Let's leave it there. It's a very difficult picture, but it's a very important picture for the financial world. Well, you can see there now there's $6 trillion worth of this AAA security stuff out there. That's a lot of dosh. Right, US total credit market debt as a percentage of GDP, another mega chart to get our heads around. So we're in the United States of America, we're going back to 1928, 29. And we can see what happened before the crash, the corporates mainly. This is kind of linked to yesterday's Japan and the lost decade, and now it's the households that have the huge debt as opposed to the corporates in Japan that Prag Cap was talking about. You can see there was in the Great Depression time, there was a great rising up in the household debt, but the main debt was being held by the corporates, and it was the corporates that got hit the hardest. Right, so that crashed down, the corporate debt. That was what's who call them now? A balance sheet recession. That was a balance sheet recession, most certainly for the corporates and for the households in the United States. And you can see that was the equivalent of the two lost decades for the United States, the Great Depression. And government took quite up quite a lot of the slack. You can see government goes bigger and bigger and bigger. GSE and financials absolutely not counting. So as time has gone by, we can see households have recently really ramped up their debt, and so it is balance sheet recession for the households. You can see they've actually turned over now in that bottom pink figure at the bottom right. Corporates have expanded, but not much. Financials have expanded an awful lot. That's interbank lending, banks lending to banks, lending to banks, lending to banks, just back scratching. But a lot of that lending has actually gone out to households, so it's in for mortgages. So it's hard to know where that financial green should really be. Should it really reside in the pink? But it does actually reside in the financials, and that's what might not get paid back to the banks, and that's what's put the banks in so much trouble. The GSEs is the same again. It's residing with the GSEs, or the American government stroke taxpayers at the moment, but maybe that should be either with financials, government, or the households, because the money has actually gone to households in mortgage lending. So it's a tricky picture, that one. And you can see that really the government, except for now where it's just taken off greatly, hasn't been taking on too much debt. So the balance sheet recession, I'd say it was households, but is also a problem for the financials because they have lent to the households. But corporates are safe enough. So does that mean 20 years? It's hard to say. Housing is mega important to the picture. That is certainly something we can say for sure. And then move on. Regulation and governments in the Financial Times, a Eurobond or an inflation solution. This is a bit interesting. It's not normal straight Euro stuff. The normally staid Bank for International Settlements, where we got the first chart from, waded into the debate on the merits or otherwise of the European Union regulation last week. Okay, specifically the central bankers' central bank, that's the BIS, rounded on Solvency II, the new EU-wide regulatory regime for the insurance industry, which could yet form the blueprint for tightened regulation of occupational pension schemes. It's meant to go for all schemes like that. Right. Solvency II, due to come into force in 2013, will make it more expensive for an insurer to hold equities and corporate bonds. The BIS added its voice to the chorus, arguing that the directive will diminish the role of insurers and potentially pension funds as long-term investors in equities, instead rendering them more short-termist and risk-averse. This is regulators telling holders of pension money where it is safe to hold the pension money. But perhaps the most mind-bending element of Solvency II is its treatment of sovereign debt, which is assumed to be risk-free, meaning it does not need to be backed by even the skimpiest of capital cushions, providing it is denominated in an insurer's domestic currency. It is difficult to know if this is a stroke of monumental stupidity or a flash of pure genius. Anyone who genuinely believes Greek, Portuguese or Irish sovereign debt, for example, is risk-free needs to go and have a long lie down. Encouraging Europe's insurance and pension funds to overdose on such toxic trash would seem a case of almost criminal recklessness. But the sovereigns desperately want to get that paper away, so it's just forcing them into buying it. I think we're going to see a lot of this. Let's finish with, no, it's not quite finished. Trichet, ECB would reject Greek bonds as collateral. This is very much on the Euro battle that's going to take place on Thursday. The European Central Bank chief said it could not accept defaulted bonds as collateral, and that governments would have to intervene to correct things were Greece government to debt to be rated as a default. On Thursday they will be discussing whether to let Greece default or not in an organised and orderly fashion, and Trichet is saying, well, if you do, we're not taking the paper at the ECB, thank you very much. All part of the battle. and finish as part of the battle as well, because it's certainly going to be the battle of this week. EU Business gives us Bundesbank chief slams Eurobonds. The head of Germany's Bundesbank central bank attacked Sunday proposals to issue Eurobonds guaranteed by the Eurozone states as a way of helping Greece, saying it would lead to a transfer union. Nothing would destroy more quickly and in more lasting fashion incentives for a solid budget policy than joint guarantees for sovereign debt, Jens Weidmann told Bild and Sonntag weekly in an interview. What he's saying there is, if the bonds are just going out willy-nilly, we can't get hold and shake governments for doing wild spending things. They'll be covered by the Eurobonds, which will just be dished out to anybody equally. Well, based on something or other. But this is exactly what some politicians and economists are proposing in the form of Eurobonds as a solution to Greece's problems. That'll come up on Thursday. The result would be European taxpayers, and first and foremost German ones, vouching for Greece's entire national debt. It would be a step towards a transfer union, something which Germany has correctly opposed so far. Again, this is going to be another of these days where they're going to sort this out once and for all. Not.